Welcome back to another episode of Better Decisions. My name is David Siddons and I am your host. And for those out there, before we start, just to remind you, I've been buying and selling real estate with my team in Miami, South Florida for more than 15 years now. So if you're a buyer or a seller, investor, give me a call. Specifically, you're an investor, this will be an interesting conversation. Without further ado, I'm going to introduce, I'm actually going to have you say your last name because if I say it, I'll probably butcher it.
That's okay.
So, Ellie, thank you for doing this. For those out there, just please introduce yourself to the audience and then we'll get going.
Okay, well, thank you, David. So I'm Eli Bracha. I'm the director. I'm wearing many hats, but I guess my official job, I'm the director of the School of Real Estate at Florida International University. We run a master's degree in real estate and also undergraduate classes in real estate. So I'm a director of the program, also a professor in the program. My specialty is real estate investments, which is what I teach mostly. But beside that, I'm also in the real estate world, kind of living it. And that means I'm a consultant for real estate investors, all the way from mom and pop investors on small investments, developments, things like that, all the way to large institutions. And I advise them with the buy decisions, sell decisions, portfolio allocation, things like that. So I do a lot of things that are what I called real life real estate in addition to just teaching in the classroom. And I think when I bring those real life things into the classroom, that's what the students enjoy the most.
Really well said. And I think you're actually very humble and I'm going to add into that. I think Ellie is the most qualified individual on this podcast to date. That's not to disqualify anybody else in there for their own fields, but in terms of within the real estate investment world, you obviously you have your PhD. I was obviously Googling you before, and I went through your Instagram page and your LinkedIn page to look you up a little bit, and it's really impressive. You got a master's degree in economics, you got a PhD in philosophy, finance, and real estate. You're currently teaching at FIU, but you've been previously teaching in other universities as well. You started off in Kansas. I know you got your degree initially in Kansas, and then obviously from there, you've written 50 academic papers, been included in the Wall Street Journal, The Economist, CNBC, Bloomberg, New York Times, Forbes. You published reports by the Journal of Real Estate and ranked third in the world for real estate research productivity. And I also read that FIU is now ranked as the number one in the world for real estate research.
That is correct. Yes, we have a great team in my department, which I'm very proud of. FIU is a very young institution. It doesn't get, I think, enough recognitions for the things that we do, but we have a lot of bright spots. One of them is real estate. We have great researchers and teachers that are doing both. And together we rank number one. It's not for the first year. I believe it's the third or fourth year that we're ranked number one in the world. We just recently, I think 3 or 4 years ago, we surpassed University of Singapore, which was ranked number one before us. And until then, we said we're number one in the US. Now we say we're
in the world.
Yes.
Well, if you are an investor of real estate and you're looking at any of the realms, whether it is residential or commercial, multifamily, single family, whatever it is, this, I think, is going to be something that's very interesting for the audience out there, because given the amount of, papers that you've written, the studies that you're doing, and the ongoing research, and the on-the-ground activity that you're involved in, this is going to hopefully open your eyes, open everyone's eyes to what is going on in the world today, what's going on in the real estate market, and particularly, obviously, as we sit here in South Florida, what is going on with South Florida? I want to get into that, but first of all, what I want to draw back to is that you've got young adults now that are coming into your lectures and at the university, and they are learning about the real estate market. What are the metrics that are being taught to these young adults? What are the fundamentals? And from when they started, like you said, 20, 30, 40 years ago, what's changed? What's different?
I think the main thing that is different today is that the same theories we had in economics for decades are still here. The difference is that today you can actually test it with data. I mean, really, if you think about it, just even go 20 years ago, which is really not that long, into the early 2000s, you could not find information about real estate readily available. You know, if you want to know what a cap rate is in a certain area, if you want to know what a vacancy rate in a certain area, or what is the NOI growth or things like that, is simply not available. If I want to know what you paid for your house 20 years ago, depends where I live, I have to actually go to the county and pull off the record myself, and it will be basically half a day. Today I can do it in a few seconds on my computer, and then I don't just do your house, I do all houses in a particular area. So the data is available today, which makes those theories actually actionable. To me, it doesn't make much sense to teach a bunch of theories if you cannot act on them. And, that is kind of a typical economics degree 20, 30, 40 years ago where, okay, we're teaching you supply and demand and all those beautiful graphs. If you can't do much with that, then what is the point? Today, we are using these theories to create, kind of a background or fundamental understanding of how the world works. And then we use data in order to support those theories and show how they really work in real time. And even more importantly, the exceptions where they don't work. And then try to understand why this general law of economics works, but doesn't work here.
So the real world applications to these, the studies of what's going on within the markets and the metrics that's being used. And you're right. If you go out right now, and even in the last year with the emergence of AI, what we've seen is an incredible uptick. Even if I go into the Florida MLS screen, and I think a lot of realtors barely use it, there are a lot of software tools now that are tracking so much data, and it's increasing by the day, that it's not just, we used to look at dollar per square foot, months of inventory, absorption rates, days on the market, number of transactions. Now there's a lot more. There's a lot more of them. Some of the macro data is massively increasing as well.
But David, I think the important part of that is that clearly we have, the amount of data that we have exponentially grew over the last couple of decades. And it's growing so fast. And everybody talk about big data, analytics, etc. All this data is worth nothing if you don't know, number one, how to analyze it and how to understand and digest it. So I think for most people, actually data availability grew too fast for them to be able to do something with it.
Do you worry about abuse with that data? Because again, the press get hold of, I've seen so much information put out by the press, and some of it I'm concerned that there is a manipulation of data, selective information, without playing the whole story.
Either that or simply naive. Look, I mean, I have reporters call me almost daily to interview for this, paper or the other. And many times, if I respond the next day, it's like, oh, it's too late. We already, we already wrote the article.
We already wrote it. Right,
and the point is that they need an article for tomorrow. So what do? And I'm not saying all of them, because of course the more quality publications are a little bit more careful. But in many cases, it's okay. We have this piece of data, so we're going to write a report. We have 2 hours to write some verbiage about it, and we're going to publish something. Yep. And I don't think in many cases is because of bad intention or trying to put the market in a good light, bad light, or biased in some way. It's simply because
they've got a deadline and they're trying to get something out there.
They have one piece of information, and this is what they go with. I think the more sophisticated publications and where they have reporters that are really trained in a certain area, they are doing a better job of that. But yes, when you have so much information out there and it all have to be pieced together to really tell the true story, it becomes more difficult to do.
And I think that's important because we are going to layer some of that data that's out there in the market right now. And I want to start by the $1 million question that everyone comes to me is what's going on in the market? What's going on in the market today in South Florida? That's like the $1 million question that everybody asks every time I'm in an elevator or I'm grabbing a coffee or I'm going to a restaurant or I'm just having a barbecue with friends. It's the $1 million question. In order to get there, you posted recently on your Instagram about the real estate cycle, and you talked about the recovery, expansion, hypersupply, and recession, the 4 stages that we're in. And obviously, the part of the cycle that we're in right now, I want you to expand on where we are in the cycle right now, how we recognize a transition from one part of the cycle to another, which is obviously some of that tricky part. How do we know we're going from expansion to hyper supply? At what's the tipping point? And expand on the super cycle. You mentioned about super cycle. So there's 3 sections to that. I'd love to hear your part, because understanding the big picture is very key, because you're a long-term, you take the market from a long-term view. You said when you talk about investments, it's 5 to 10 years. So you're not looking at like 6 months. You're looking at a wider range.
Yeah. Okay, so David, you ask a lot of questions there. So first of all, yes, you've been asked everything about real estate. Of course, everywhere I walked in, oh, so what do you do? Well, I'm a real estate professor. Oh, wow. What do you think about the market? And it's always the market. Which market? Which market?
That's that, yeah.
Which market, which area, which sector, because everything, of course, look different. So that's where, I don't try to be a professor outside of the classroom. So I give usually a pretty generic answer. But of course, the answer will be very different, depends on the sector. So let me answer your questions about cycles and where we're at and how we detect, I guess, the transition between the different phases. So we know that the recent collapse in real estate prices, which was starting in 2007 when it peaked and then collapsed, was very, very severe. And I think it was probably the first economic big recession, we call it the Great Recession, that the cause of that recession was real estate. We had many recessions before, they're not triggered directly by real estate. And that caused not only collapse in the economy, collapse in real estate prices, and a lot of fear. Of course, construction stopped. All those things that, happening in a regular cycle happened to an extreme amount during that phase. So you're sitting in 2009, prices are basically half as much as they were before, in some areas more, like South Florida. Developers are not building anything, and then people are trying to put back the pieces. And people that had some capital were basically taking advantage of situations and buying deals that turn out to be very lucrative. As you know, it takes time to gain confidence. And then once you gain confidence in real estate, it takes time to then start building, creating new supply. Also, if you remember, a lot of the builders, developers just disappeared and never came back. So what happened since then? We have an expansion. Let's call it from 2000, let's say 10. You have expansion, but this expansion happened from a very low point and very slowly, because a lot of people said, I'm not touching real estate ever, or they're unable to touch real estate because they just were bankrupt got thrown out of the market. And that expansion that usually would take, and it changes because of the market dynamic, but 5-8 years or so, we're now 13 years in, right? I mean, if you really think about from 2010 until 2023, with a hiccup of COVID, but basically, for a while.
There's a few little blips within this.
And the reason for that is because during the whole cycle, we're still, and I'm talking now about the residential side specifically.
Yeah, let's talk about which group we're talking about. So residential.
So we're talking about residential, even though it is greatly tied to others ones. I mean, yes, they're not all acting together, but there's a strong correlation between them. So let's talk about the residential side. 2007, we are about 3 million units oversupplied. Okay, everybody buying second homes, third homes.
3 million across what area are we talking about? 3
in
million?
The whole United States.
Okay.
So think about it. At that time, I think the total units in the United States of housing was about 115 million. About 3 million were basically oversupply. So you have 3 million too many houses in the U.S. And then we have the crash and people stop building.
And Miami's crash was considered more, Florida was the poster child for that excess. And so our drop was seen as more aggressive than it was in the rest of the US.
It was more aggressive. And the reason for that, and I'm getting away from the point of the thing, but it was more aggressive because the market here is more volatile. First of all, capital that came in, a lot of that depends on other economies that are less stable than the US. So, think about South America, Latin America. A lot of the money came from there. And if those economies that are less stable is what driving prices here, then you get more volatility here. A lot of the purchases here were very speculative just by the nature of the people and the kind of capital that arrived here. So, for example, if you bring capital here from a country where inflation is very high, or if you basically fear that if you leave the money where it is in Latin America somewhere, it will just disappear.
So Argentina and Brazil were too big.
Yeah, so it will disappear if you leave it there. You can come here and say, you know what, even if I lose 20%, I'm still better off. That is a different mindset for investors that is a setup for more volatility. Mm-hmm. So it's, you're no longer looking at, okay, is the return I'm getting fair? Is the comparable is, okay, I'm losing everything or maybe lose something.
And this is a mindset in that 2010 to 2015 period. We saw that big South American influence.
Mm-hmm. And of
not
course,
post-pandemic, but then we did.
Yes, I mean, I think some of that still exists, except they'll become a little bit more sophisticated. I think those investors do look at the kind of return that they're getting. But for many of them, they would not consider investing in Atlanta or, Nashville or, Boston or whatever it is. They just, we're coming to United States, Miami is where we're going to invest. And that makes Miami a more volatile place. So yes, the volatility here was higher. But just to finish my point, so from 3 million of oversupply, we stopped building almost altogether. And we broke even in terms of supply demand around 2012 because we're building, roughly 500,000 units less than we needed every year. Mm-hmm. And you take a few years, basically, you're running through this oversupply, and now you're kind of break even. And then we continue to underbuild ever since. And if you think about from 2012 all the way until today, that's 11 years of continued under construction. Now we have a shortage of housing in the U.S. of about 4 million units.
So housing, because when people talk about housing, there's a conversation of houses and condos. Mm-hmm. And Miami is probably the city that has the highest concentration of condos in any city in the U.S. outside of New York, I'm going to say.
Probably.
But between 2012 and 2015, there was a second surge of construction. The SLS, the Bond. I'm just thinking of like Brickell, for example, which is the urban core, which is, a very high, the most dense condo neighborhood in South Florida. And we had, at that time, a significant, or what was considered by the local economy as a significant amount of new condo construction that once all the product was absorbed post-recession, there was a sudden, flurry of related projects that were and other developers being built in the Brickell downtown and Edgewater area, and everyone talks about this cycle that we have these cycles with a lot of construction.
But the reason for that is that that is what you can build fast, right? I can take a piece of land, I can build 400 units relatively quickly. Mm-hmm. You cannot build so there's a housing shortage in South Florida. Yeah. People need a place to live. And
houses. We're talking about actual hard units. Single family.
No, I'm talking about units.
Units in general.
Units in general. And then how do you address this unit issue? Well, of course, a lot of people want a house, but because of land constraints, you can't give everybody a house with a yard, etc. And if you really think about, the condos, well, so again, let's go back for a second and talk about the U.S. in general.
Yeah.
So out of 130 million units of housing, and housing, I'm talking condos, apartments, duplexes, and
everything
single-family homes,
live
everything that people live in, about 18% of that is apartments and condos. Okay? Only 18%. Now, of course...
Only 18?
Yes.
That's interesting.
Yes. So when you're talking about this supply or record construction for apartments and condos, it is true, but that's again one of those headlines. It's that, okay, so 18% of the market is being oversupplied because the rest is not, and because we have a severe housing shortage we need to address. Does it mean we're going to have an overall housing oversupply? Not anytime soon. Okay, so basically they are addressing it from the point where they can build quickly to address the demand. But in order to address 4 million units that are underserved, you need 500,000 for 8 years in a row extra above and beyond what you need for the general population. So for Miami, then okay, so you have the shortage of housing, and then how do you address that?
But why is it like? What's the definition of a housing shortage? Like, what's the premise behind that fundamental?
Basically, how many households there are versus how many housing units there are. Okay, every household needs a home. Now, if they don't have a home, then they start living with roommates. So a household can be anywhere from.
So not renting.
It's
not. Is that? How does it supply that those who are renting those? It is
renter, right? I mean, if you're looking at a family, mom, dad, and 2 kids, that is a household. Also, a household will be a single individual that is unmarried with no kids. That's also a household to consider. They both need a place to live. Now, in the case of the individual, they have more options. They don't necessarily, or it's easier for them to say, okay, I don't have my own place. I'm just going to stay with my mom, dad, uncle, whatever it is, or get a roommate. And then I basically get my household with another household. Together we get one unit. But that is not a permanent solution. Eventually that person wants a place for him or herself. At some point they will form a household that's going to be more difficult to share. And some of those is basically a pent-up demand for units that are needed, right? A lot of people, they want to have their own place, except they either can afford it, so they stay back with their parents or their room. I think right now, and I forgot the exact statistics, but I looked at it recently, the percentage of young adults that live with their family, young adults talking 25 to 34 years old, that live with their family, it's basically the highest been in decades.
There was a statistic on that with like the millennials, who may be the first generation who are less wealthy than the previous generation. Or I think it's and part of the conversation was that the cost of being able to buy, to live, and own their own property is so prohibitive, limits them.
And I think it's because they choose to be in certain areas.
Yeah, because it's very geo-specific as well. I think it's important to let us know that we talk in general terms, but the reality is that buyers and sellers think in far more specific sub-market terms. They're like, okay, I'm concerned about Brickell. I'm concerned about Coconut Grove. How does this relate to me and my specific neighborhood that I'm looking at? Because understanding families coming together with housing shortages can occur at lower levels on the economic spectrum. But those who are working wealthy, and Miami is not a cheap city, those who are earning, let's say, good, what they classify as good money, not the national average or even the state average, those who are making good money are saying, okay, well, I'm not sharing a house with another family. I'm renting. But now it's trickling into the rental situation, got really expensive, and there's all these other variables. But you're saying overall, people are having to compromise their living situation that is not ideal, and more houses, more product would alleviate this problem, and those people would choose to then buy if there's availability.
Or rent, it is okay, except that because whether they buy or rent, it's really irrelevant for the supply-demand issue of how many units and how many households there are. The issue of buy versus rent, then a lot of that is based on do you have the down payment or not, and how permanent this housing is going to be. And a lot of the younger, generations, they're choosing to rent simply because they value things like amenity, location. They don't plan to stay there for a very long time, so they choose to do that, not necessarily because they can't afford, but in many cases because they don't also have the down payment.
Yeah.
And a down payment become a real issue for expensive cities like Miami.
And we have a large rental market. I think Brickell statistically is about 80% rentals. It's got a huge statistic. So kind of getting back onto the economic cycle and seeing as things move forward, we are at this position right now because you talked about, again, the super cycle. We transferred through, I know there's a lot of ground to cover. We transferred through that big recession. We came out of that. We went through 15, and obviously the markets continued to move. We had a little, ironically, and I remember my best year ever was the pandemic year, 2021. We absolutely killed it because we saw a whole new category of buyers come flooding in, the migration buyer, which was just unbelievable. That has in your mind, looking at Miami specifically, that's expanded our super cycle, that's created a level of our super cycle, or it's a combination of what we saw before? Because there was a bit of downturn before the pandemic. Some of the markets dropped a little bit.
Yes, but yes. So basically, yes, that is expanding the super cycle in places like South Florida. But in general, the whole idea that we build less units than needed, in general, everywhere, of course, with exceptions, all through the US, is what making this super cycle or the expansion period a lot longer. Because the whole idea of the expansion is that you are building as many units as needed, plus some to make up for whatever, I guess, shortage you had from before. This is not happening right now. You still, even at this point when we're building, I guess, enough, we're just building enough, not enough, and then some in order to solve the problem. So that makes the cycle go longer.
We are, from looking at this real estate cycle, are you saying that we are still in expansion phase before we hit hyper supply?
Yes, especially on the residential side and on the industrial side. Those are the two sectors where basically there's just not enough of what you need. So in the residential, we talked about the shortage, the number of units. And then on the industrial side, the whole idea of what industrial space is changed over the last decade. It used to be a lot of like light manufacturing, heavy manufacturing, etc. And now, which can be located almost anywhere. It can be 20, 30, 50 miles out of the city, as long as it's in a place that is close to an exit of a highway. And now what we call industrial, a big part of it become logistic. And of course, we order more things online and want it today or tomorrow or very, very soon. Then you need to have those last mile locations. And it's very difficult to create those last mile industrial or logistic or whatever it is you call in big cities. That shortage is here to stay.
Yeah, logistics is important.
Yes,
because of Miami's
and it's growing
port.
exponentially. It's growing exponentially, and that space you cannot build up, right? I mean, basically, it's one story. In some cases, you can get away with 2-story. Depends on how you do that, but you're not going to have a 30-story industrial space. So space is very, very, very precious. A big, big issue for industrial, and that's probably going to make the shortage of industrial here to stay for.
So that's an interesting investment area for those who are looking in the commercial. I remember when they expanded, I think the conversation a few years ago was the expansion of the Panama Canal, and then they allowed these really big vessels to come into the port of Miami. And I remember looking at this closely, and there was originally a lot of the logistics was flowing down from Virginia. Things were coming in from the north and coming down through to the south. And then once they expanded, the boats were coming into Miami, and then logistics was flowing up. Is that true? Did that happen?
I think that's part of that, but I think the big part is not so much about where the inventory is coming from. It's more the fact that because we are have more of the online shopping, that require more logistic, more in place, more basically last mile locations.
I think my wife might be supporting an entire warehouse right now because I have
my wife does
deliveries on Amazon in everyone's house is unbelievable. So looking at obviously that part of the cycle, I want to get into something that everyone, I mean, you go online, and I was doing research on this, and I was writing about it, that if you Google Miami real estate right now and you put it into YouTube, it auto-populates with Miami real estate crash or Miami real estate bubble. Let's get into that question, because I've looked online and I've seen a lot of videos, and some of them have some interesting points and some of them obviously are half-baked. Now, as someone who actually, really studies and has that economics background, and you're obviously in the thick of it, I would love your take on some of the things that are being discussed. And I want to get in the process, as we go through this, a little bit more granular, because I know we can talk in general terms about the South Florida market, but I'm sure that the people who are watching the video, watching this podcast, and who come online say, okay, but I want this to relate to me. And I serve what I guess you classify as the luxury sector of the market. We sell condos and homes ranging really from $1 million up to, the sky's the limit, 30, 40. And that demographic, that group is obviously, moving and being influenced by other factors that obviously are nothing to do with those who work in the much lower level sectors of the market, or maybe not. So there were several options that came out there, opinions that came out there in the market. And I wanted to discuss what you've seen, the human behavioral observations of what's happening. One of the things that came out was a study, and again, data was pulled, about the price earnings against property value. What we were observing, or what came out in San Francisco, was that properties were worth 10 times what they were, those individuals, couples or more, were making on an annual basis. And they said this is unsustainable, because there's a point where if some of the variables turn, it becomes unsustainable. It's like that old Warren Buffett saying, you don't know who's swimming naked till the tide goes out. And people have, Icarus flying too close to a position that if something changes small, their taxes go up, their insurance premiums go up, or any of those variables change, interest rates go up, they can't keep the house. They have to get rid of it. And that market can't sustain that level, and people pull back. South Florida never had those variables, according to this source. It didn't have these numbers. But post-pandemic, we now see South Florida running in a position where for a lot of homeowners, they're seeing 10 times, the homes are 10 times what they're making in a year. And their argument is that's unsustainable, and that's got to lead to some kind of correction.
Okay, so let me address that. So number one, when you're looking at price to income, which it is an important metric, you have to think about, are those numbers true? The price and the income. So prices are true because we can get them out of whatever it is, MLS, and they're reliable. Yeah. The income numbers, those are very tricky, specifically for South Florida. Number one, because we know that recently a lot of the money that is flowing here is being earned somewhere else, or basically wealth that moved here. Yeah. So if somebody wealthy moved from New Jersey or New York or Boston, they may not have an official income that is qualified to make this, whatever it is, the income number higher, but they're coming with enough wealth, so that supports that. And also we have, of course, a lot of income that's unreported. Now, unreported income is true and exists everywhere, but we know that it's more so in South Florida. I think that is safe to say. So a lot of people earning quite a lot of money that is unreported. Again, that is contributing to a low income reported compared to what the real income is. So whatever numbers that you see that's price to income, the real number is actually lower than that. So that's number one. Now, the second thing is that price to income ratio is important, but to me, more important when you're talking about recession or correction, anything like that, is that we have prices in the market that are not supported by fundamentals. And what do I mean by that? So if you think about what happened during the recent housing boom in the 2000s, you see prices went up significantly very fast, and then rents stay stagnant. So you basically have prices that are not supported by fundamentals, which is rent. This is a definition of a bubble. This is not high price. It's a bubble because you have prices not supported by rent. It did not make sense to buy at some point. Then you rent the same units. What's happening right now, it's very different. You have prices go up and rent prices going up with it. And when you see rent prices that going up with purchase prices, number one, it provides fundamental support. And number two, it provides evidence that those prices are actually what people are able to afford. Now, it's very easy to say, prices are so high, nobody able to afford it. But it's silly, because prices only go as high as people can afford, especially when you don't talk about speculation, especially when you talk about rent prices. Purchase prices, if you buy something with 0% down, interest rate that is temporary, then it's a speculation, then people can pay whatever. But when you're talking about rent prices that are consistent with purchase prices and people pay those, it means that the income is coming from somewhere. That gives me a lot of comfort. The other thing that gives me comfort in the market, to say that it's expensive but not in a bubble, is the fact that everybody's waiting for the crash. Since 2009, and I'm sure, David, you talk to those people all the time, I'm waiting for a correction.
Oh, God,
I'm accumulating cash.
Every week. I'm waiting for the market to correct, then I'll buy. How long have you been waiting?
I didn't do it in 2009 because whatever it is, I wasn't liquid, I didn't in a situation. Whatever the situation was, I'm going to take advantage next time. And you have so much of that money, dry powder, is sitting on the sidelines waiting for a crash that almost by definition will make the market not crash. Because as the market, if it will come down maybe 5-10%, and then all those buyers will come in, jump in, and take advantage.
There's a lot of
those
liquidity
short
in the
prices.
markets, for sure.
Yeah. So when you have dry powder on the sidelines and you have a shortage of a product that everybody need, you're not going to have a strong correction. Yeah. And I think an evidence for that is with interest rates went from 3% on mortgages to 7%, and markets still did not break. You actually see housing prices and rent prices still continue to go up slowly in East Florida. That's evidence that the market is very, very, very resilient, simply because of what you just described.
Yeah, I've noticed as well, and this is just an observation with clients that I've got, the amount of cash that was purchased, that used in the purchases, not leveraged with mortgages. There was a lot of people who came and said, well, I'm going to buy with a mortgage at 3-4%, but I don't actually need to. I don't need to. I'm perfectly able to pay all cash. Plus the amount of savings that they had. A lot of people came in and they had a large amount of savings, and so when they're buying real estate, they weren't necessarily, not all of them were buying with a mortgage, so they didn't have that stress of paying a mortgage. They could hold it. Interesting points, and again, I think that, this is just people taking national statistics, taking national averages, and again, that statistic was what people make on average in South Florida, and I think the statistic is like $60,000 a year. None of my markets that I deal with, people are making they might make that in a month, they're not making that in a year. It's not relevant. The affordability crisis.
It's very difficult to hire anybody for less than $20 an hour. If you think about $20 an hour on a 2,000 hours a year, that's 40,000 for a household. We're talking about 80,000. There are very few.
It doesn't add up.
Below that.
One of the discussions is the rest of the country and people talking about other cities going into kind of a recession mode. And because there are a lot of and again, this is something taken online that someone put out there, and they're communicating out there about crash bubble. There's a lot of out-of-state owners. There's a lot of second home owners in South Florida where let's say they own a condo on the beach. It's not their primary residence. They come and use it a few months of the year. The rest of the time, it may not even be used. It can just be locked up and left. And there's a lot of that goes on. And they're saying that as we go into a position of, let's say, economically challenging environment, that those investment properties are going to get offloaded because they're a non-necessity.
I think actually the problem now is less than it was in the past. So if you take the typical building in Bracha that somebody from Brazil, Colombia, Venezuela, wherever it was, they bought it so they can use it maybe a few weeks, a few months, a year. It was very common 10, 15, 20 years ago. It's less common today because the rent that they can receive on that space becomes so much higher. And they say, you know what, I'm just going to rent it out. Because before, I'm okay with giving up $2,500 a month, not renting it, having for whatever I need. But now when the rent is not $2,500 and it's $5,000, they say, well, I can't give up that. So they're renting them out. I see it myself in my building that I think was at least half empty just 5 years ago. And today is, I don't know the numbers but you just feel. I mean, you see the gym, you see the elevators, you see the pool. It's definitely more than 50% full. It's probably 80 or 90% because every vacant unit is very costly. So yes, of course, you have the people that buy the second homes. I actually think it's less of an issue today than it was in the past because the opportunity cost is so high. The offloading, it's possible, but a lot of those people that really are able to have now in an expensive city like Miami, having a second home, they have a lot of staying power. They don't have to liquidate quickly. Mm-hmm. And a lot of the people that bought units this time around, unlike before the 2007, they bought it with real down payment, so 20, 30, 50% or cash. That means they're not zero down payment like we had before. That means they have enough equity, since then also prices went up. They're not going to be forced to sell. And really what caused a strong price correction when people are being forced, a lot of them all at once, to sell properties, that would create a correction. This time, they're not going to be forced to do that. They just have enough equity that they can
hold out.
Yeah.
There's a point that was raised, and I don't think it was more about crash. I think it was more about big slowdown and the migratory aspect. And I know the migratory rates were incredibly fast during 2021, 2022. Even they're still going on right now. But the argument is that they've slowed down a lot, and they'll continue to slow down because a few years ago, Miami was so much cheaper compared to California, compared to New York. And then obviously we caught up to the point that they're neck and neck now in many areas. And then obviously in the last, I think since the beginning of the year, we've seen a number of major cities where there's been big drops. And there was a piece that came out in this article, it was a conversation, that was that in San Francisco, for example, prices have dropped by 25-30%. So the buyer that may have moved from, say, San Francisco would look at it and say, well, actually Miami is the same price. And in fact, I can get a deal in San Francisco right now. So maybe I won't sell and move there. Maybe I'll sell and maybe I'll just buy something here at a better price.
Yeah, of course. This growth in movement to South Florida was especially high during COVID. And that cannot be sustained, and it's not going to continue forever. I do think that over the longer term, yes, it's probably going to have a slowdown for a while. Some people moved in here during the pandemic are coming back, but not as many. A lot of people actually fell in love with Florida and stay.
Yep, I saw that.
And a lot of people are telling their friends, they're selling, putting pictures on Instagram. In January, we're in the pool, where they are in Boston and they're not in the pool in January. And those are the kind of things that, they have power. So people are still moving here. But yes, at some point, because the city is becoming expensive, you're not going to be expecting the same rate of growth, but you don't need that rate of growth every time. Actually, you cannot sustain that from the amount of, supply of housing. So as long as you have demographic trend that are positive, as long as people want to move to the city, as long as companies are moving here and they're starting to pay better and better wages for things outside of hospitality and tourism, now we have, finance and tech, and those are coming with,
Do you believe on that there's our fundamental drivers, our engine, the South Florida engine, the Miami and Fort Lauderdale engine, has fundamentally shifted from what it was before? As the tourism hospitality driver has now got and I know we had Brickell as a financial hub, but the level of financial activity, the level of tech, are you seeing this? Because you're involved in these kind of conversations at a business level.
I see that, but it's still very early, right? We're not Silicon Valley, we're not New York City or Charlotte for banking. But that's fine. First of all, you don't get there in one day, and you may even never get there. But the fact that we're starting from very low base and actually growing those industries that are high-paid industries that bring talent here from other places, and then it pushes universities to offer certain education and all that. That is what Florida is doing. It is happening. I see that with our universities, what we offer, the students that are coming here. It's definitely good.
I actually had a parent who turned to me and said, my child's first choice was down here in Miami. Their second choice was Georgetown. They didn't get into South Florida, into Miami, so they went to Georgetown, which is ironic because our education system in South Florida, years ago, there used to be a level of snobbery that would exist in the conversation with people that were coming from New York or California, and they'd say, yeah, but Miami doesn't have a great education system. Weirdly enough, and this comes back to the safety security aspect, which is one of the fundamentals. Obviously, if we look at the laws of economics, that second tier in Maslow's is safety and security.
David, it's a chicken and the egg question. If you have here, if the migration originally was for people that don't value education as much, then they don't demand it, and then education at a certain level. But then if you have a second wave of migration that coming with people that do demand and do value education, then it will get here.
Yeah.
So yes, again, it's a process, but it is happening. Look at, so I work at FIU. Look at what FIU has achieved in 50 years. It was basically a community college level institution for many years until maybe 2 decades that it's really supercharged. And now we have some of the finest colleges in the country. I'm not just talking specifically, of course, I can talk about the Holo School of Real Estate and the great things that we do, but this is not the only spot. I'm not going to say specific departments, but there's a lot of bright spots there that can really compete against any school.
And you're getting fed by some really excellent, the private school system down here, the schools. And again, we're sitting here in my office in South Miami, down the streets, Ransom Everglades, Carrollton, you've got Gulliver down the street. These are actually feeding and feeding great students to top level colleges now. And what I've observed is, and again, this is an observation, personal observation that I've had me and my team relocated 150 families over the last 2 years down into South Florida, which is an unbelievably large amount of families. It was almost on a daily basis. We were out there, and we're still out there with families now. And what I learned in the process was they said, we'll put up with a lot. We'll put up with high taxes. We'll put up with bad traffic. We'll put up with a little bit of pollution. We'll put up with, an impingement on the quality of my life. But what I won't put up with is when my children are being affected. And safety, security, and education were the top reasons for them to move down here. Taxes were the original consideration, but they were not the driving force during that pandemic period. And it's interesting now that I feel like their eyes got open and they said, you know what, education down here in South Florida is actually very, very good.
You have options, and as the demand will grow, you're going to have more supply. It's really would fit that. There's no question about that.
Okay.
I'm not worried about it, but it is a process. And again, sometimes when you have a lot of migration over a short period of time, so a lot of the schools that you talked about, it becomes a lot more difficult to get into those.
Yeah.
The tuition became a lot more expensive, so it really became kind of the elite game.
That's a limiting factor, getting into schools.
Okay,
as well.
But then as you have more demand for those, either they're going to be offering more spots or more schools like that will surface.
The expansion of the school system is definitely something that is in conversation, and I've heard about that a lot. I've seen major schools expand their campuses. I've seen new schools come down into South Florida, and I think that's going to continue because the one limiting factor that I see dealing with a high-end single-family market is the prohibiting element is the ability for families to get their kids into school, not to find a house, not for the job, but actually get their school, get the school of choice for their son or daughter. I want to get a little bit more granular. There's something that we touched on. Again, it was raised in a YouTube video, and then kind of we'll move into some of the other areas. And it was about the rental market. And you mentioned the rental market going up. Miami obviously has a very broad demographic, and each neighborhood, we study each and every neighborhood in its own ecosystem. And we then subdivide those neighborhoods by price points. So if you go into our website, we have a market statistics page, which gives people kind of like, a user-friendly layperson's software that will allow them to see what's going on within that sub-market, the months of inventory, the dollar per square foot, the absorption rates, number of sales, et cetera, et cetera. The rental market has been a conversation piece for the urban core and the condo market because a lot of rentals that have occurred. And Brickell was always like front and center on the study when it came to the success of the condo market in South Florida. We now have, and we're talking about supply, right now in South Florida we have 36, from what I count, major new construction projects in the pipeline over the next couple of years, which is, it's a good number, 36 projects, ranging from, boutique buildings with 40, 50 units up to 300-400 unit projects.
Over the next decade?
Over the next 5 years.
Okay.
Now, there's more probably boutique projects than there were before. I know in the last cycle, like Icon Brickell, we saw 1,800 units getting produced. We saw SLS and SLS Lux, Brickell Heights, 300-400 units per tower. The new product coming in is almost, by majority, it's on the luxury end of the market. It's $2,000 a square foot, which we never saw before.
And that's what I was about to respond. So you have to think about, when you're talking about, okay, so a lot of inventory coming to the market, I love that inventory actually is, I guess, there's a larger proportion than usual that is the ultra luxury. Mm-hmm. And that is not really affecting the general real estate market. Yeah. Units that are selling for $2,000 per square foot in the St. Regis or, Aston Martin or whatever it is building there, those are second, third, fourth, fifth home for people. Those are not first home. And that is not addressing
And they're not going to be rented out. I've sold a bunch of units through the market, and those buyers are not renting those out.
Somebody's going to keep them as a second or third home, yeah.
But the interesting thing that I wanted to get to was that right now, we were observing, we did a study, for example, and we're doing a video on this afterwards, which you can link in after you watch this podcast, and you can watch that video, where we started to observe for the first time in the last 6 months in Brickell, the rental numbers for 3-bedroom units. For example, we're doing a study where the rents they were asking $9,500, $10,000 a month, and now they're getting down to $7,000 a month. And the original purchase price on those units was around $1 million. So they were paying $1 million and they were getting, $9,000 a month. So of course, there's a great return on investment. The cap was great. What we've observed right now, and we're starting to see this across the board in Brickell, is the rental numbers obviously are now coming down to about $7,000, $7,500 a month. And the resales values of these units are now running to about 1.6, 1.7. This is just in one particular study, which when you do the math, a $1.7 million asset that's yielding you $7,000, $7,500 a month. Before expenses. And now we've also got to be conscious, and I want to touch on this as well. The HOA fees have all gone up in a lot of these buildings because the insurance carrying premiums have increased, because citizens are now becoming they're the government-backed insurance, and a lot of the other groups are pulling out. So HOA fees are going up, carrying costs are going up, and the concern is that some of those investors are going to look at their asset and say, you know what? I'm not getting a good return on this. I'm getting maybe 2%. Maybe I should offload this. And the buyers are going to then weigh this up and look at that and say, well, I as an investor don't want to buy that unit and rent it out, because I'm not going to pay 1.6 and then rent out at $7,000 a month. To me, if I did a calculation, I may be okay at 1.2, which suggests some sort of correction. Now, this obviously is a very hyper-granular study, and we're looking this, but it's a little concerning to see that within that market, we have this kind of blip.
Let me interrupt you here. I think what you presented here, it is a concern, but I think what you missed there is that the same units, it didn't just go from 10 to 7.5. It went from 4.5 to 10 to 7.5. And it's a little bit unfair to say it went from 10 to 7.5. That's already the froth of the market that came off, right? I mean, during COVID, there's a period where there's panic that I cannot find houses. I'll pay anything. It wasn't really market prices. It was panic prices that, okay, maybe the price was 75, but I'll pay another 2,000 just to make sure I get it. And then let's figure out my living situation. And that panicked disappear. And that's where you saw what I call the froth is coming down, and they're now trading for, let's say, 75.
So that's a recorrection. You're talking about a recorrection.
Yes, so that's a recorrection, and I think that is, again, where the panic just does not exist anymore. But generally speaking, yes. I mean, at some point, and you're getting to the point of rents do or do not support fundamentals. Generally speaking, I mean, if you're looking at the condo market in Brickell for years, the cap rates there, if you really do a true cap rate, where you really are subtracting everything you should subtract, the management fee, and the HOAs, and the reserves and all that. I mean, many cases you have a cap rate of 1%, 1.5%, and things like that. And it's like, how did it make sense ever? Well, people bought them for different reasons.
Yeah, it was safety. It was the currency. There was a big currency play, and I totally get that.
It still plays a role. And then cap rate went to actually reasonable numbers. I mean, depends on where you caught the market. During the pandemic, you could get, a maybe 5% cap, maybe 5.5% cap, even when you do it correctly. And now it went down to maybe numbers that maybe don't make sense for the pure investors, but would still make sense for some people, either that they just want to secure a unit in a area that they want to live in for a long time, or basically, hey, Brickell is where things are going to be, and I better get in now because who knows later. Look, the whole buy versus rent, and you follow kind of my work. I do a lot of this buy versus rent analysis, and I wrote about when buying is better and renting is better in different areas and time and all that. And renting make a lot of sense in many situations, but when you're talking about a hot city like Miami, you have to think about what is the risk of buying, what is the risk of renting. A lot of people are afraid to buy because they think prices are going to come down, and and I understand that. I don't think they're coming down significantly, but this is a concern. To me, the real risk is that you rent and prices go up significantly. People do not think about it as a risk, but it is a real risk because then you basically price yourself out of the market. I mean, how many people got priced out of the market during the pandemic because they rented something for $2,000? Now the rent is $4,000. They can't afford that. And at the same time, prices
they can't afford to buy it either.
So the real risk is for people that want to stay here long term is renting and losing on the price appreciation, basically pricing them out. People do not think about it. People only think about what will happen if I buy right now and then prices drop. And for those people, I would say, well, again, this is kind of a general, but for those people, I would say that even if prices do drop, the fact that you have demographic trends that are in your favor, it will be short-lived. So it may take a year, 2, 3, 4, 5 until.
And I like your view because you have a long-term view. Now, the reality is, you made a comment before we started rolling the camera, which was you kind of were poking fun at that ridiculous comment that I know that realtors will come out and say it's always a good time to buy. When we look long-term over a 5-10 year period, there's blips in the market and the markets can come down and they can come up again. And obviously long-term, we're talking about what I guess we're concluding as a robust system that's strong, that there's nothing that's fundamentally kind of coming in there and going to cut us off at the knees to create that pop, that bubble, that collapse. Within the market, within the time, within areas, there are periods of time when people will look to consider, you know what, I think I do want to sell because I've got other opportunities in other sectors that I might put my money in. And I do believe, and I've looked at how I've moved my wealth through real estate in Miami over the years, there is a time to jump off one elevator and get onto another, even within the same city. And I think that when we do our studies, obviously we do them at a hyper-focused, granular level. There's always going to be sometimes a period of correction within subprime markets. Overall, obviously, they're going to get better. I don't think you can just blanket go out and say, just go into Brickell and buy right now.
No, look, yes, of course, it's a little bit more sophisticated or, I guess, complex than that. But you have to really think about, okay, are you looking for a home for your family or are you looking for investment? And those are two different scenarios. So basically, if you're looking for a home for your family, I believe that in a hot city that is expanding over time, as long as you're not grossly overpaying or the market is not ridiculously, unrelated to rent prices, basically the best time to buy is when you need a home. And really the risk of not buying one and the market running away from you is more than the other risk, which is you're not going to buy, you're going to rent, and then, that you're going to buy and prices will come down. So for those people, I would say as long as the market is reasonable, you find a place that you like and you have a need for that, go buy a home. Now, for the investors, and you're talking about, jumping to a different elevator and having other opportunities, I think those are the more sophisticated investors. Those are not the investors that are buying one unit at, Rich and Rise and, renting. This is different type of investors. And for those, yes, they may be trading between one type of investment to a different one, maybe to a different city, maybe to a different sector, maybe outside of real estate altogether. I don't think that's a big part of who owns condos in Brickell. I really don't.
So I'm going to raise something now, which is, and again, one final point that was put out there into the ether, was interest rates. And interest rates obviously now at 7%. And one of the things that had come out was there was an argument that as we get closer to election next year, we'll see a strategy of interest rates being dropped. Now, there's no direct influence of elective power over the control of the Fed and what they're doing with the rates. The other argument is there's some kind of indirect influence. Now, I'm not a politician, first and foremost, nor am I involved in what the Fed are doing or how the political arena is being run. What is your opinion of the changes within the interest rates as you see them over the next, I'm not going to hold you to this, of course, over the next 20 months as we go through this year and into next year? Do you have any thoughts on our the interest rate situation?
Of course, yes. I mean, that is the first question is that what do you think about the market when people meet me? And the second question is that, what's going to happen with interest rates. It becomes definitely a hot button, top of mind for many people, whether they're looking to buy a home, staying on the sidelines, or investors. And really what happened with interest rates is very different this time around than other times, because the disruption in the market was basically a broken supply chain. It wasn't an over-demand that overheated the market. So when you have a broken supply chain, it creates shortages for different reasons, not because there's not enough supply, and because there's no supply chain. So then the Fed, of course, started increasing interest rates in order to slow down the market, and we see that it's working. And actually, I would argue more than just it's working for delay. So a lot of the things that are already happening in the economy, you don't see in the data. The recent number that we saw was 3% inflation. This is basically where we want to be. Yeah, we want to be at 2%, but 3%, it's right there, especially if it's coming with a lag. We're already at 2%.
So you believe we're legitimately there, because some argument says, oh, we're not there, it's all just fluff, and that's just, hyperbole. But from your what you've seen academically and studying out
those that say
there,
that it's fluff would say that, so all the CPI numbers are fluff. So we still need to go to a fluff 2%. I don't believe it's fluff. I believe that, yes, CPI can be measured in different ways, and maybe some people disagree with how it's being measured, and that's okay, but that's a different argument. The point is that our target of slowing inflation is already happening. I mean, first of all, you see shelves are full in most cases. That is by itself easing.
Ability to get a car. I mean, that was a good example.
Ability to get a watch, or ability to get the kind of milk that you want in the supermarket, or diapers, or formula, or any of those things. This is less of an issue. Ability even to get a home. Okay, so all those things that we could not get our hands on just before, now you can do them. You maybe have to pay, but the prices, even though are high, they're in place. The Fed want to appear very aggressive, because that's, they really have two tools. One of them is that they're tightening the market. Another thing is telling the market they're going to tighten the market. They're both just effective. They rather tell the market they're going to be aggressive than actually being aggressive, because being aggressive is an action that is very difficult to take back. And telling the markets we're going to be aggressive is something that...
So it's like having a child and telling them you're going to spank them and actually spanking them.
You rather tell them you will if they don't behave. So that is what the Fed is doing. They may increase rates, maybe one, even some people say twice. I don't think so, but it's possible. But I do think that what you're going to see is probably toward the end of this year that you're going to see the bets of interest rates continue to go up will disappear, and you're going to start talking about interest rates coming down. And when those talks are happening, then the spread between a 10-year treasury and mortgages will shrink. Sure. Right now, it's as high as 3%. Mm-hmm. It should be, whatever it is on average, about 1.8%. Just by shrinking the spread, you're already in the mid-5s without the Fed doing anything.
And that has a huge influence on our buying market, because we talked about the reality right now in the housing market, the single-family market, which is something that I have a conversation with every day. I'm out there calling sellers saying, would you entertain a conversation of selling your home? And they've said to me, quite candidly, David, when I bought my house, there were several variables that occurred. Number one, I paid a really good price on my home, so I paid lower price, which meant for me lower taxes. And additionally, I paid 3, 4, 5% on my interest rate. So now if I sell, and you're going to give me a big premium for my house, there are three things I'm going to have to consider. Number one, the availability of what I want to replace the house that I have right now, which is still not there, because single-family homes, especially the new sector, takes 3 years to build a new house. Right now in Coral Gables, Coconut Grove, year of permits, 2 years to build. That's how long it takes. Number two, my interest rate's going to go up for my next home. Number three, so are my taxes. And so the conversation that's being had is, once rates start to come down again, we're going to see a sudden boost, a surge of buying activity again in the single-family market, which for the last quarter, 2 quarters that I've seen right now in Coconut Grove, Coral Gables, Pinecrest, primary markets, even Miami Beach, has slowed down. It hasn't slowed down the dollar per square foot. It hasn't dropped the values, but it's slowed down the number of transactions. And I can see that ticking up again once that happens, because more people will trade, more people will buy.
And that is why when people are, and again, I'm not selling houses, but people, of course, come to me with, should I buy a home? Or talking to agents, what should I tell my clients when they're sitting on the sideline? And again, if they want to buy a home and the decision point or the main factor is that we're not buying now because we're waiting for interest to come down, they will come down. But when the time they do, the prices will go up, because if higher interest rate did not bring them down, then lower, that means market resilient, low interest rates will bring them up. And then we'll basically have to have more competition and probably overpay. So what I would advise them is, if you think about buying a home anywhere in the next year, just buy it now.
So date the mortgage, marry the home.
Yes, and refinance later. Yes, of course.
Yeah, which totally makes sense. And I say that too. I mean, look, would you rather pay a little bit more on your mortgage, or would you like to pay another $500,000 on the value of your house, the cost of your house?
And a lot of people say, well, really what I care about is the mortgage payment, but it's not the full story, right? Because then when you talk about resale and you talk about equity in the home and wealth creation, all that, what you pay for the home really matters. So you better have and of course, you're locking the price that you pay, and then you can take advantage of mortgages as they're coming down. And if this is what you anticipate to happen, which I think a lot of people do, it's just a matter of time. I believe the process is going to start sometime later this year, early next year. Some people maybe disagree, and it will happen another 6 months or maybe even a year later. Okay, but it's not 10 years down the road. And even if it is, let's say the interest rate do not come down, that's because inflation stays high. The biggest component of inflation is housing. That's almost by definition mean that housing prices will continue to go up. So almost any direction you look at this, you're going to be losing by waiting for interest rates to come down. And again, I'm talking about not just go speculate, buy a home because you're looking for interest to come down. I'm talking for people that actually need a place and they're not buying right now because interest rate 7 and they're wanting to be at 5.5. Once they go below 6, when there's a 5 in the beginning, psychologically people will start looking at homes, the demand will increase and the market will change.
And the psychological winds as they blow are massive influences. I always, it's kind of like the Ray Dalio, play the player, don't play the game. And looking at what the human behavior is en masse and talking, again, we have these conversations with hundreds of people, thousands of people every year. It's interesting to see the sentiment and their mood and their motivations and what they're fearful and what they're hopeful about, because, it does give us an underlying sense of what they're going to do. Their gut is still going to drive them.
Especially when we talk about residential homes that are, primary residence, a place where you're going to be living with family. I mean, we know that this is, yes, it's a financial decision, but it's a personal, emotional decision.
It's a need.
Yes.
So we've touched on some of the fundamentals, and I just want to let people know when they're going out there and they're trying to get data and they're trying to get information, because you are so in this, and there's a lot of sometimes misdirection of data out there. We've touched on interest rates being something to pay attention to. We've touched on, the supply and demand, dollar per square foot. Are there any of the other metrics out there that you would say, if you're going to look and try to understand the market, and as you're teaching your students to understand the market, what metrics should you be paying attention to that you may not be looking at right now through your Zillow or Trulia, search?
I think the trends stay the same. One thing maybe you did not mention, people did not look at before, is rent prices, even when you purchase home, because again, that's the fundamental. Mm-hmm. I do think that the change. Okay, so people talk about prices go up and down, but the rate of how they go up and down when you adjust for interest rate at the same time is extremely important, because when people say stagnant, yes. So people talk about stagnant market here. It's like, okay, so the market's slowing down. Maybe that is actually very impressive. That market slow down if you consider that at the same time rents rate from 3 to 7. That is very different than if rates stay at, they went from 7 to 3 and then the market are stagnant. I will tell you, well, there's a problem here.
Yeah, that would. I mean, it makes sense.
So looking at all of those factors together is very important, rather than just looking at them individually.
You raised this is something that we were discussing earlier on, kind of off camera before we were shooting this, which was about how I remember back when I was doing the studies at the condo market back in 2010, 11, we were looking at this process where the conversation was months of inventory as our supply and demand, one of our fundamentals. And the conversation was, we have 110 months supply in this market. It's going to take us 9 years to absorb this product. So you shouldn't be buying right now because we're going to be oversupplied.
And of course,
but that was off that speed.
Yes. And of course, the assumption that we're going to stay at the same speed.
Which is a huge mistake. So really, I mean, I think it's really important to understand the speed, the absorption rate, the speed of transactions that are occurring within the market, because it might be one speed right now, but when that shifts, everything else does too.
Yes. So when economist is telling you, well, this is true, all other things equal, which is a standard economist answer, you have to, of course, understand, and that economist knows it's himself, that all other things are never equal. All other things are never the same. So, for example, yes, now we have X amount of inventory in the market. Well, what happened to the pace of how people are going to buy houses if and when interests come down? All of a sudden, you're looking at a very different number, even if the amount of inventory is the same, just because the speed of how you consume that inventory is becoming faster.
Something that has come up in conversation a lot over the last 6 months, which is really, it's a very granular question. It's very hyper-specific, but the insurance game, the insurance premiums and what's going on right there, and dialogue about people who have older homes in flood zone areas that are built at lower elevations are now seeing massive premiums being increased across their annual flood insurance, home insurance, and obviously older condos having assessments, having higher fees. Have you had any conversations of that, and is that factored in? Are you seeing any patterns there that are worth mentioning?
Yeah, I do think that the insurance issue is, if there's one concern I have about the South Florida market, is the insurance situation. I generally do not like government get involved. I do think that this is one of those places that, for the general good of everybody, I think those are kind of places where government should be involved, providing some kind of a comfort to the insurance companies, some kind of subsidies, some kind of a system that make it more affordable, because the recent increase in insurance rates are unsustainable.
And the control, the ability to almost it become a monopoly, where there's no free market conditions anymore.
The problem with those things that nobody's getting involved and nobody getting spooked until it become a real problem. And I think we are right where it's becoming a real problem.
Yeah.
That it's becoming a conversation among politicians and some decision makers that hopefully will help the market adjust to that situation.
I believe right now, if things aren't addressed the way they're addressed, that there are homeowners in areas, flood zone areas, and older homes who have, homes that they maybe, they renovated the inside, but they didn't do anything with the exterior structure, or they didn't elevate their homes, they couldn't. Those are becoming areas where they're becoming, a pig in the room, where those are people I'm saying, if you market's good, but if you're going to sell, these are the people who should be selling, because I'm concerned that they could really end up having a piece of real estate that's really considered land value.
Yeah.
As buyers look at the insurance premium saying, there's no way I'm going to pay double on this house that I'm going to pay over a house up the hill.
Yeah, no, and that is true. I've done a study. Actually, it wasn't in South Florida. It was actually the study area was in North Carolina, but it's the same thing. Basically, looking at houses somewhere in the Outer Banks area, and looking at erosion of the land on those homes that are located basically first line to the ocean. And even though the issue of land erosion and rising sea levels, those are different, but the outcome is the same. And we basically look at those houses, their values over time as the land erode. And this erosion of land is actually something that is very predictable. There's maps that are showing you if you live in this area, you're 180 feet from the water, and this land is eroding at 5 feet a year. So it doesn't take a genius to figure out, okay, so 180, how many years basically going to be in the water. And we're looking at all those houses that are first line to the ocean and how fast their land is eroding, what happened to prices. And basically what we see is that homeowners, they just don't care. And that is showing by how much people are paying and for the homes or whether they are selling or not. So basically, it plays almost no effect until the water is right there. And then you see a big drop in the market. So and that is something that is true for, in many areas of psychology. People studied that before and saw that until the problem is right there.
I call it the smoking effect. Yeah. People don't worry about smoking cigarettes until they get cancer, and then they're like, oh. or something happens very close to them, I feel like people almost shut off. It's like, well, if I'm in a room and everyone else is in the same problem, then maybe the guy next to me gets hit, but I'm okay. The law of averages. But, obviously that changes.
So unfortunately, because of that kind of behavior, I think that those things will not be addressed until the problem is like right there.
Yeah, I agree. I want to finish off with real estate investment trusts, something that you're involved in. It's something that you're actively involved in. It's not, part of the studies. It's that you obviously have your hedge fund, which is, I'm trying to find the name of your hedge fund.
It's okay. We don't have to mention the names right now.
Well,
but
you're CEO of Tree Capital, and you look at publicly traded US REITs. Mm-hmm. If someone was to come to you right now and say, I'm looking to invest in the market, I want to deploy capital. I was investing in the stock market, and I found it frothy. I find it volatile. I find real estate much easier to analyze, and its movement patterns are a little bit slower and easier to work with than the speed, the craziness, the nanosecond trades that happen within the markets, when markets can, stocks can be, destroyed in one day. What would you say to those people coming in? Because I'm a big believer in real estate investments. I invest in real estate, and I found myself to suffer on the stock market and do much better on the real estate market. What do you look at right now, and what do you consider to be hotspot areas to focus on?
Okay, so first of all, when I'm talking about real estate investment trust, even though it is in the part of the stock market, I'm not talking about the trading of today, tomorrow, the hyper speed of the market. I'm talking about purchasing, if it is a good investment, whatever trust it is, and holding it for a medium period of time. So looking at 5 to 10 years, and then you reevaluate. It doesn't mean that you're going to just sell it then, but at that point you evaluate. So you need to have this long-term view, just like you would on a real estate investment, right? It's very rare that you're going to be buying a piece of property today and then putting it on the market in 2 months just because the market
You're not a day trader.
Change. So first of all, we need to look at a longer trade. Real estate investment trusts are very attractive for people that want to buy something at market value and getting fair returns. And again, talking about passive investment, and you're talking about diversification, and talking about ease in terms of just ability to move money in and out. Historically, real estate investment trusts return about 10% per year. Right now, if you look at the prices of a lot of those trusts, they're trending for cap rates that are very fair compared to what you can get in the market if you were to buy the property, directly from somebody else. So if you buy a shopping center, industrial park, or a multifamily, directly in the market, or whether you buy it with as an investment trust, you're going to pay very similar prices. A lot of people do not know how to see that it's the same prices, because I know when I buy an apartment, multifamily, and a cap rate is 5.2, if you understand just a little bit of real estate, you say, okay, I'm getting it at 5.2. When you buy a trust that is selling for $112 a share, well, what does it mean for cap rates? You need to know a little bit more in order to convert it. But what I'm telling you is that right now they would sell for similar cap rates, with the benefit of diversification and passive and all those kind of things. And then, so which one should you do? Well, for direct investment, there's a lot of better benefits from a tax perspective, and it depends on your individual tax situation. And people that do have this tax advantage for maybe should go and buy directly, or for people that really getting a deal. So just to buy something for market price directly, and then you lose diversification, you putting all your money in 1 or 2 or 3 deals, I think it's a loser's game. A lot of people make a lot of money that way, but also lose a lot of money. There's a lot of things can happen that can hurt your one single asset that may make it a bad investment. So if you tell me that you buy something that should be at a cap rate of 5%, but you got it at a cap rate of 5.5%, great. Or if you're talking about specific deals where you can really add value. So again, you think about there is investment trust. Those are kind of plain vanilla. You're not going to play a specific asset in a specific location, a specific growth story or unique story and make a lot of money on that. You're going to be basically buying the market and do
buying the index
over time. Yes, basically. You can do better if you really understand the local market, the local story of that particular asset or that particular city or that particular, factory that's moving here or company that will move your asset more. If you're just buying something, hey, I'm just going to buy something at market, you might as well just buy your REIT. But if you are led by an advisor that can lead you to those specific situations where you can make abnormal returns, that is where the money is. Perfect.
This has been a fantastic podcast. You've given us so much good information.
Thank you.
I want to leave on a light note. I want to make this fun. We're going to play a little quick fire question game. There's no right or wrong answers to this. Okay. It's just a bit of fun. So I'm going to give you two options, and I want to say one or the other. So, homes or condos?
Homes.
Miami Beach or Coral Gables?
Coral Gables.
Miami-Dade or Broward?
It's a tough one.
Boutique or high-rise?
Boutique.
Office or warehouse?
Warehouse.
Stock market or real estate market?
I think I answered that before.
That's an easy one. Inter Miami or Miami Heat?
Miami Heat.
It's good because I represent a couple of Miami Heat players, so that'll make them smile. Cap rate or appreciation?
Cap rate.
And finally, macro or micro?
Micro.
Love it. If you want to know what that means, give me a call. Ellie, thank you so much for doing this. Again, look, we're going to flash up our information at the bottom of the screen. If you'd like to communicate with Ellie, he's a wealth of knowledge. I guess you figured out from watching this. Any questions, you can bring them to it. You can put them at the bottom of the video on YouTube. We will answer those questions. We'll endeavor to answer those questions. Thank you again. And as always, stay tuned for another edition coming soon of the Better Decisions podcast.